the top 5 ETFs to own for life. Now look guys, obviously I am largely a stock picker, and that has worked well for me in certain years, and other years it has led to some losses. But one of the things I'm going to be doing in the future myself is hedging against my own stock picking ability by putting $1 into ETFs for every $1 I personally put into individual stocks. So that is just one of the ways that you could potentially utilize ETFs, even if you're currently totally on the side of being a stock picker. Now that being said, before we get into the individual ETF selections, I just have to mention that I am not a financial advisor. This video is not any sort of financial advice, and you should always do your own research and due diligence above and beyond this video before investing. So coming in at number 1 on the list is by far the most popular ETF out there. That is the Vanguard S&P 500 ETF, trading under the symbol VOO. Now, this fund represents 500 of the largest US companies, specifically the ones that are publicly traded, whereas it's possible to invest in their shares as a public investor. So this ETF gives you diversified exposure into the best businesses in America at a very low cost. And that cost comes in at an annual expense ratio of just 0.03%. Now, just to put that into perspective here, on $100,000 invested, that would be an annual cost of just $30. Now, there are hundreds of billions of dollars invested into this ETF, and it's also a market-weighted ETF, which is very important. That essentially means that the larger a company is, the bigger a piece it represents within that fund. So when you buy shares of VOO, 6.52% of your money goes into Apple, 5.96% goes into Microsoft, 3.9% goes into Google, 2.88% goes into Amazon, and 1.75% of your money goes into Tesla. And then, of course, it's going to be a smaller piece into the next 495 different companies on that list. Now, on top of that, this fund does pay a dividend, so that is something to be aware of as well, which currently comes in at a yield of 1.53%. So VOO gives you a good blend of both growth and income. That's why a lot of young people especially love this ETF as a long-term investment. And you can, of course, reinvest those dividends to earn compound interest. Now, if the first ETF we talked about is a bit too boring for you, this one might be up your alley. In fact, if you like technology, you're probably going to love this ETF. The Invesco QQQ ETF is the second most traded ETF in the United States. This fund tracks the NASDAQ 100, which is the largest non-financial companies listed on the NASDAQ. Now, the NASDAQ is a major stock exchange that mostly encompasses technology. However, there are some financial companies listed on the NASDAQ. This fund nixes those, so you end up with the top technology companies primarily in the United States. Simply put, this is the real innovation fund out there, not anything that was offered by Cathie Wood. If you're looking to invest in innovation and US technology, this is one of the best ways to accomplish this in a diversified manner. This is a broad, diversified investment into mostly large US technology giants. The cost, however, does come in quite a bit higher than that Vanguard ETF that we just looked at. To be precise, 6.6 times the cost. That expense ratio of 0.2% annually is going to cost you $200 per year on a $100,000 investment. It's certainly not the highest we're going to see on this list. However, I did want to point out that Vanguard does have some of the lowest cost products on the market, and when you leave the Vanguard family, you should pay very close attention to that expense ratio just to make sure it is not too high. And again, just like with VOO, this fund is market weighted, meaning the larger the company is, the more that it makes up in the fund. So of the 100 companies that you own, 13.17% of your money goes into Apple stock, 10.43% of your money goes into Microsoft, 7.23% of your money goes into Google, 6.39% of your money goes into Amazon, and 4.43% of your money goes into Tesla. Now, that's the thing that can be pretty crazy about these market-weighted ETFs, is that even though there are 100 different holdings, just the top two make up almost 24% of the total amount of money invested. Now, this ETF does pay a dividend. However, since this is mostly technology companies, they're focused more so on growth, not income right now. So it is a significantly lower dividend yield than we saw from VOO. And that yield comes in at 0.61% annually. So this ETF is largely focused on growth with a very little focus on income. Sure, you could still earn and reinvest that dividend, but that is just not going to be the primary way that you're trying to make money by holding on to this ETF. By and large, you're looking to make money through the growth of the share price of the different companies owned within this ETF. However, this is going to be more volatile than the S&P 500 because it is technology companies, and it's going to be a lot more volatile than many income investments out there. Simply put, you're going to see more up and down price movements, and so if you are a complete beginner, you might be nervous to have those ups and downs early on. However, that being said, over the long run, we should see the most asset appreciation or growth of the NASDAQ compared to other indexes out there because of how this is the most innovative companies in America. So coming in at number 3, we have a real estate fund offered through Fidelity. The Fidelity Real Estate Investment ETF, trading under FPRO, is an actively managed fund that invests in real estate, not equity in companies. So everything we talked about up until this point is about funds that invest a pool of money into publicly traded U.S. companies. We're now talking about a fund that invests a pool of money into real estate. And this is possible through a publicly traded investment known as a REIT, or Real Estate Investment Trust. Just think of this as real estate trading like stocks on the stock exchange. So this particular ETF over at Fidelity has a team that actively picks what they believe are the best current REITs, and then they invest the sum of money of that fund into that portfolio of REITs. As of right now, those top 5 holdings include Crown Castle, 10.7%, SBA Communications, 7.6%, Prologis, 7.2%, Welltower, 5.4%, and Equinix, 4.2%. Now, each of these different REITs are involved in a different type of real estate. Crown Castle is a communications infrastructure company that owns over 40,000 cell phone towers that they then rent out to different tenants. SBA Communications is another global wireless infrastructure REIT. After that, Prologis is a warehouse-based REIT. Welltower is a healthcare-related REIT. And then Equinix is a data center-related REIT. So right off the bat, you can see this is a diversified pool of real estate. And as of right now, it is actually mostly industrial-type applications, not so much residential or commercial. Now, that being said, this is an actively managed fund, so it is going to come with an additional cost. The other funds are passively managed because it's basically a computer algorithm tracking the S&P 500 and then the NASDAQ 100 and then making changes to that fund as needed. This instead is an actual team that is actively researching different REITs and then allocating money in the best way they personally see fit, and that is going to come in at a higher cost with an annual expense ratio of 0.59%. So on $100,000 invested, that is $590 annually as the cost. Now, REITs tend to be more focused on income and less focused on growth, and since they have the cash flow of the rentals, they tend to pay out a higher dividend yield than most stock investments. So as of right now, that current dividend yield on this is 2.48%. So FPRO would be best used as a long-term compound interest investment where those dividends are reinvested every single quarter, allowing you to earn more future dividends and growing your money exponentially. That being said, don't think that being invested in real estate through the stock market is going to shield you from the ups and downs, because REITs tend to have very similar correlation to the overall stock market. So when stocks are up, REITs are usually up. When stocks are down, REITs are usually down. So before we get into number 4 on the list, I want to quickly cover where to actually buy ETFs. Now, since pretty much every ETF out there pays some form of dividend, it's important to invest with a brokerage that allows you to take full advantage of that by being able to reinvest that dividend. Reinvesting dividends, of course, allows you to earn compound interest, so this is especially recommended for young people. So for me, I personally use and recommend M1 Finance because they cover all of the bases when it comes to ETF investing. Number 1, they have automated dividend reinvestment. Number 2, they automatically rebalance your portfolio as you add more money or earn dividends. So as the different allocations or stocks or funds within your portfolio change, the new money going in is going to put you back to your target as close as possible. And third and finally, with fractional shares, you can remain fully invested, which is really cool. In addition, they offer dozens of pre-built portfolios that own low-fee ETFs from top providers like Vanguard, Invesco, etc., and those are completely free of any management fees. M1 Finance is totally commission-free, and if you guys want to check them out, my affiliate link is ryanoscribner.com/m1-finance, or you can check them out in my description down below. I also have a completely free 30-minute step-by-step video training that's going to walk you through how to get started with M1 Finance. That's going to be down in the description below as well. So coming in at number 4 on the list here is another Fidelity ETF. This is FBCV, the Fidelity Blue Chip Value ETF. Now, this is another actively managed Fidelity fund, meaning there is a team of professionals doing the research and then deciding what the actual assets are. So these fund managers are purchasing stocks on investors' behalf that they believe are undervalued based on cash flow, growth potential, and many other factors. So this means that your money's invested in medium to large-sized companies that are well-established and often time-tested. Currently, the top 5 holdings of this fund include number 1, Berkshire Hathaway at 4.38%. Number 2, Comcast at 3.58%. Number 3, United Health at 2.73%. Number 4, Google at 2.65%. And number 5, the healthcare company BMS at 2.64%. So as you can see there, you have a lot of defensive. You also have utilities there represented with Comcast, telecom. You have healthcare. You have Google, which is really sort of this basically utility at this point in a weird way, providing different necessary online services. So this is not going to be a growth fund. This is a value fund where you're looking to invest in companies when they are near their underlying value and a good buy based on their cash flows, not so much investing in what's going to be the most growing company or innovative company. Now again, since this is actively managed, it's going to have a higher cost identical to the last one at 0.59% or $590 per year as the cost on $100,000 invested. Now, this ETF does come in with the highest dividend yield on our list at 3.62%, making this a fantastic compound interest investment. Now, on that topic of income and dividends, coming in at number 5 on the list is another income-focused ETF. That is SCHD, the Schwab US Dividend Equity ETF. Now, what you'll like about this fund in particular is that, similar to Vanguard, Charles Schwab is known for having extremely low costs on their funds. This particular fund comes in with an annual expense ratio of just 0.06%. So it is the second lowest cost option on our entire list. To put that into perspective, that is just a cost of $60 per year on $100,000 invested. Now, this fund tracks and replicates as closely as possible the performance of the Dow Jones US Dividend 100 Index. This index includes high-yielding, dividend-paying stocks with a long track record of consistently paying them. On a side note, if you're wondering what companies have grown and paid dividends the longest, these are called dividend aristocrats, and I have a full article over on my website explaining every single one of these 60+ stocks on this dividend aristocrat list. These companies have both paid and grown dividends every single year for 25+ years. Be sure to check that out down in the description below. So back to the Schwab US Dividend Equity ETF. Currently, the top 5 holdings within this fund are Texas Instruments at 4.36%, PepsiCo also at 4.36%, Amgen at 4.31%, Merck & Co. at 4.29%, and Home Depot at 4.23%. Now, the dividend is a little bit less than the Fidelity fund we just covered. However, it is still coming in at a very respectable figure here of 3.41%. So anyways, guys, that is going to wrap up this video on the top 5 ETFs that you could potentially own for life. The idea here is being invested and not having to worry about actively managing your money. Now, you would want to change allocations in ETFs over time as you get older and closer to retirement, but you can pretty much create an ETF portfolio and then set it and forget it, especially using a great automated brokerage such as M1 Finance. Once again, if you want to check it out, guys, my affiliate link and free training link are both down below, as well as that full article on the Dividend Aristocrats, which is a really great piece if you're looking to learn more about dividend investing and potentially be on that stock picker side. Thank you guys so much for tuning in. I hope you enjoyed it. If you did, please drop a like and subscribe. And as always, I hope to see you guys in the next video.